Good morning, everyone, and welcome to March 1st, 2018. Market just opened, the bell rang 45 seconds ago, and I'm seeing a NASDAQ future that is dropping. The futures were pointing to a flat to positive open. And now that we've actually have the opening bell behind us, we are seeing some hesitation. Mild strength in the Dow, the S&P. The index is the strongest right now. It's up 0.25%. The Russell is the weakest. It's down 0.25% itself. Volatility for both the S&P and the Russell is up. It's up 2.5%. I'm sorry, volatility, the VIX is up 1 3/4 and the Russell's up 1 4/10 just about. Now NASDAQ futures catching a bid. In 15 minutes we are going to see there's been a whole bunch of economic data that came out, and it's in the video edition of Traders Espresso, which it's not accessible yet. Once it is, I'll publish it. But in a nutshell, the economic data that comes out just confirms that this is a healthy economy and that it's nothing overwhelmingly inflationary looking. But basically everything's coming in at or above consensus. Okay, some of the highlights that I would point to would be personal consumption expenditures, the price change number, 1.6 consensus, 1.7 was the print. On a month-over-month basis, the personal income month-over-month was 0.3 and it came in. The print was 0.4. Personal spending consensus was 0.2. It came in at 0.2. Jobless claims, continuing jobless claims were a little bit higher, but the initial jobless claims were lower. The initial jobless claims was the biggest difference. 226 was the consensus and the print was 210. U.S. manufacturing PMI will be out in 11 minutes. That will be out at 9:45 Eastern Time. And right now you can see that the NASDAQ futures are heading up towards that 250 period moving average. We're also going to get construction spending out. That's going to be out at the top of the hour at 10 o'clock Eastern. We're getting the ISM manufacturing PMI that's coming out also at 10 o'clock Eastern. ISM prices paid, that number comes out at 10 o'clock Eastern, and Jerome Powell starts his testimony before the Senate Banking Committee, all at 10 o'clock. So, a lot of data today. A lot of data. A lot for investors to absorb. What is interesting about yesterday, if we look at the course of the day, which is this right here. At about 7:45 Eastern, or 9:45 Eastern, I'm sorry, which is about 15 minutes after the market opened, the last of the economic data had come out. It was the Chicago Purchasing Managers Index, and that came in dramatically lower than was expected. Let me see if I can find it here. $64.2 was the consensus. The print was 61.9. So there was a drop in home sales. There was some kind of hot inflation numbers. Not hot, but I mean at consensus. So not really nothing to dispel the inflation story. But you can see that initially, the markets cheered the fact that that the PMI number came in lower. That, oh, thank goodness. That means that Jerome Powell and his Fed buddies don't have to raise rates. But then as time went on, people realized, wait a second, what if, this is my interpretation, this is my opinions, some of you might disagree with me, but I think, in my opinion, the thinking that had taken hold was, well, then this validates what the Fed, this is in reaction to rate increases. This is going to embolden the Fed that they're on the right rate path. That means that they're not going to bring the punch pull back. And just that they kind of stewed on it throughout the course of the day. There was an attempt at a rally, and then right around 2 o'clock Eastern time, the wheels fell off and it just plummeted. Okay. Now we're seeing an S&P that is down. So just in the time that I've been talking to you, we've crossed over negative territory. It's not a whole lot. I mean, the S&P is down 8 basis points. The Nasdaq at 100 is the only thing that's positive. It's up 5 basis points. But we are seeing, we're seeing red now. Volatility's up. Gold's down. The crude is down again. It was down yesterday. And volatility, of course, is elevated back up over 20. Volatility had managed to fall below 20. Well, it's back up there now. So this is, this is the environment that we're in. Emerging markets, VWO, it's up 34 cents. Yay! One of the things that is a hot topic today is this whole idea of tariffs, steel tariffs in particular. Steel stocks, I'm just seeing out of the corner of my eye, steel stocks are jumping because, tariffs on imported steel are going to be good for the domestic steel industry. So if we take a look at ex-US steel, it's gapped up on that news. And this may be one of the things that may be a question that's put to Jerome Powell at the Senate Banking Committee. So I'll be tuning into that in 22 minutes, and I'll have that kind of on low in the background so we can kind of follow along. Seemed to work out okay yesterday. But right now, as I look at my stochastics for the NASDAQ, for the mini NAS, this is all pretty bearish. Well, nuts. Can't win them all. Yeah, I wish I would have stayed in that. Would have been a good move. I'm just trying to take care of some business here. And I'm missing a really good move in the NASDAQ futures. And this PMI number's not even out yet. That'll be out in 2.5 minutes. I think I'll turn the stream on so I can hear it when it does come out. All right, now we're getting a good leg down. All right, so I'm back on top. I mean, I'm back up where it was before. I want to get out of that so quickly because I don't know what the PMI number is going to say, and even if I did, I don't know how the market's going to react to it. Right now, all indices are down solidly across the board. VIX has just spiked. VIX is up almost 8%. The VIX on the Russell is up a little over 5%. The yield on the 10-year note's down, you know, almost a percent. 2.841 is the yield on the index right now. But all futures are down. Everything's down around between 0.4% and 0.5%, both on the futures side and on the cash markets. VIX futures are up 4%. The dollar's up 0.25% right now.
We are down by 0.6% on the Dow, following 2 days of losses on the S&P 500, softer by 4. In the bond market, the story looks a little something like this. Treasury still big, yields low by 2 basis points to 284. And here's a novelty for you. Over the last couple of days, the dollar strength sticks. Euro dollar coming back to 120, 169. Dollar yen sat at 107 and 106.88, up by 0.2%. Big story here in the United States in the last 24 hours. Spotify finding to go public on the New York.
So at 7:45, the market PMI number should be out.
Directly on the exchange rather than relying on underwriters. The music streaming service will also allow investors to buy existing shares.
No word on Bloomberg whether on that number. There's a bit of a delay there. But the fact that we are shedding some of those losses, I don't know, maybe tells me it was good. Or, I mean, again, honestly, I couldn't tell you whether the number came in high or low because I don't know how the market's going to react to that when it does come out. I mean, the latest headline is at 7:16, which is old news. Stock futures rebound as traders brace for Powell redux. Well, they're not rebounding now.
You have to believe in the B2C companies. The track record has been kind of dicey with Snap and all that. So I'm sure there are some bearish guys as well, bearish investors. But overall, I think I expect a good IPO. The odds favor this kind of listing. And
nothing really on the trade flash.
Very risky to do this thing, but I think this, for all practical purposes, Spotify has been a public company. We know the financials. There's a solid secondary market going on, so the price discovery will not be as difficult as we think. That you usually have for Mark Lehman, I want to bring you into the conversation with JMP Securities. What's your view on the actual approach to this IPO of Spotify?
Well, obviously it's unique and it's specific to the company, and this is.
They're too interested in talking about Spotify's IPO. Talk about the PMI number.
Capital structure of the company is, so it's not too surprising, and it's a little different. I think over time you'll see some secondary shares come to the market, sometimes in blocks and other places, but it's very unique to the company. I don't think it tells you anything about the overall health of the tech IPO market, which we think is quite strong at JP. You're going to start to see some real examples of that this month and beyond, given the backlog that we've seen so far.
Santosh, how do I think of this company as it comes to market? Am I thinking this as the Netflix of the music streaming world, or is it different? I think you could say that. I mean, it's a Netflix of the music streaming business. So, and they're growing as well, and it's very popular. They have a good growth engine around it, so they have many catalysts behind them. So I think at this point they're well positioned. They're best of breed in their category, and they're the only one around there. So, I mean, we have Apple and Amazon and Google behind them, but I think they're the best in their category. You mentioned the story of them doing really, really well, but if you think about the difference between them and Netflix, they've got to hand over, I think, 70% of sales to the music rights holders because they don't produce any of their own content. So maybe the differentiating factor is that Netflix can do their own content and Spotify can't. Is that a limitation? It is in the near term because they're limited by their contracts with the music labels to do their own content, their own programming. But down the road, I'm sure they will work out some kind of arrangement with the labels and publishers. So I think that's a limiting factor. They keep 30 cents on a dollar every time. So I think that's a big. But they will work around it.
Well, no word yet.
The artists are happy. The labels are.
I know the number's out.
In the long run, I think they'll work out a constructive arrangement. Mark Lehman, the revenue growth is stunning for the likes of Spotify. We've got plenty of insiders, Santos points out, on the numbers themselves. But the margins, if you look at the margins and the amount of people who are actually paying to use the service, the average number isn't that great. In fact, as far as I know, I think it's been dropping, Santos. It's not yet climbing. So, Mark, is that a difficulty, a headwind, as you look to push forward the view on this company?
Well, I think the analogy to Netflix is a difficult one, and you brought that up. I mean, Netflix is kind of a have-to-have. Spotify sounds to me sort of a want-to-have. I mean, I'll use my personal family as an example. We are an Apple Music family. We pay our $14.99 a month. We sent a text around to the family and said, who wants to switch to Spotify? And we kind of had a 3-2 vote. We didn't have a 5-0. Netflix, if we got rid of, I'd probably be taken out of the family. So I think there's a large difference between the two, and they've got to prove that that you want to own the service, and right now you don't. You don't have to own it, and I think it's well run. They got some great insiders. They got some great investors right now who are on the board, and I think they're doing the right thing for the listing. But they got to prove that you have to have it.
Raise this as a question. If Pandora is struggling, why can Spotify do that much better, Santosh? Well, Spotify has a different business model. They have a streaming service that is the majority of their revenues. It's growing very fast, so I think it's growing at 40%, the streaming, the premium subscribers. But I think that's the mistake that Pandora made, which is an ad-based model. So Spotify has the benefit of both. They have a subscription model and an ad-based model, and it's growing on both ends. So I think in that sense, the hybrid
Jay Powell will be up in 10 minutes. I don't know if that's actually going to start on time. So right now we're seeing a little strength come back in. I mean, nothing highly encouraging, just a respite from the selling. Here we go. Manufacturing PMI came in at 55.3 versus a consensus view of 55.9. So it came in a little bit lighter than expected. That may explain why, you know, we saw a little bit of a lift here. I don't know that that was really enough. Again, good news is bad news, or bad news is good news, right? So bad news is PMI fell a little bit short. So the economy is not, you know, traders interpret that anything coming in soft, and I think it just needs to be a little bit soft. Oh, whew, that means, you know, less inflation. If something comes in way below, like the Chicago Purchasing Managers Index, I mean, that was a big miss. And that's either a concern of, uh-oh, this is evidence that the rate cuts are working, or, oh no, the Fed's cutting to the bone, you know, or not rate cuts, rate raises. Or it means, ah, nuts, the Fed's gone too far. But yeah, short is a good trade right now. Waiting to see, here's my dilemma, is that, you know, and we saw this yesterday, you know, very bearish stochastics on the 1-minute chart, and when you see attempts for it to cross back up over, those were just getting batted down by the bears because there was a lot of, it was just met by more selling. I haven't been watching this enough this morning to be able to tell you whether or not we're going to see a repeat of that today, that behavior today. What I do know is that we're making our way towards this next pivot. just reading here, U.S. jobless claims the lowest since December of 1969, 210,000. Lowest number of jobless claims since 1969. Now, I don't know how meaningful that is. I mean, that probably is actually very meaningful, because if you're talking about that on an absolute basis, which it looks like you are, that's much more meaningful. I mean, given the fact that we had a smaller population then. So if we had a smaller population then, I don't know what our working population comparison would be. I would guess, that's just a pure guess, would be lower. Still, it's 8 o'clock now, 10 o'clock East Coast. So still waiting on Jerome Powell to make his appearance. Now the ISM manufacturing PMI number is out. That consensus was 58.7, 60.8. So that came in higher. That number just came out. And so far, well, it looks like at least the NASDAQ futures are reacting positively to that. Not so sure about the Dow. Yeah, I guess so. So now the NASDAQ futures trading back up to that level of what was level of support. That is the yellow line up here. That's the pivot, which is the midpoint of yesterday's range. So this is the first level of support. This is the second level of support. Haven't cut to Powell yet.
This is not a hotel. This is let's get the check in. This is not a hotel. This is a really knowledge for the ship. This is the temperature. This is not a hotel. This is no Mexican associated at all. So you've already booked your tickets and sit right to your lunch. This is not a hotel. This is what happens when data and design are together. This is an experience. You can experience your business. You can experience
We are wordsmithing.
Let's hear what Joe Livorni has to say about Powell's testimony on Tuesday.
That's a loaded term. Again, the Fed has undershot its inflation target for 7 years. So in the context of where we've been, I didn't look at overheating as being a loaded word. In terms of the risks, if you ask people and said, look, the Fed isn't going 3 times this year. How many times is the Fed going? People would probably say 4. I happen to think 2, but most people would say 4. And that's probably why he didn't want to push the fourth table off the fourth hike off the table, because the risks, with the economy as good as it is, would seem to favor more hikes rather than few.
Do you think it's a plausible scenario that the Fed lets inflation run hot that is above its 2% target? What do you think of that idea?
I love that idea. To me, it'd be
Powell
a
said he
great
would do
idea.
that.
I would love
He
to
would
see
not
the
be
Fed
opposed to
lag
it.
the markets, meaning the markets price more tightening than what the Fed is likely to do or what the Fed is telling us it will do. That's been the opposite to what's happened over the last 7 years. I'm not sure they'll go in that direction, but it would be prudent. It's the only way the Fed would be able to normalize policy and not cause a significant bout of financial instability, which we got a taste of last month.
Time now for the executive edge, and we're going to start with some steps.
So that's what Joe Livorni thinks.
He's going to double down on what the House members were asking earlier this week about the timing of the rate hike. Now, of course, Fed Chair Powell saying that the economic confidence and how the economy has been moving has given him more confidence about the potential of another rate hike for this year. But on issues of regulatory reform, that's where things could get interesting. We should note the backstory here, which is that Senate Banking Committee Chairman Mike Crapo is likely going to have a bill on the Senate floor early next week, he tells me, regarding Dodd-Frank. Now, where the Fed comes in terms of how they are going to regulate on a host of issues, on a host of rules, rather, put forth by Dodd-Frank, that's where this could get interesting. We saw a little bit of that in the House hearing, but I would anticipate a lot of regulatory questions and follow-ups in this hearing that's about to get underway.
Mike, what stood out a couple of days ago was the new Fed chairman expressing his own view. Is that refreshing from a Fed watcher, a seasoned Fed watcher like yourself?
Well, it's odd, and the reason being is when they appear on Capitol Hill like this, they are supposed to be speaking for the entire committee. And I think that's what got a lot of traders' attention when Powell went beyond saying, we are looking at this, to I think the economy is stronger than I had anticipated, and I'm going to have to adjust my forecast. Then people look at it and say, hey, the Fed chair is the center of gravity. They're the one who pushes everybody in the direction they want to go. If he thinks things are better than they had forecast in December when they were talking about 3 increases, maybe he's going to go for 4. And that helped lead the move in the bond and stock markets on Tuesday. So we'll see if he sticks to that formulation today or goes back to talking about we. And if he emphasizes the idea of we're going to have to look at the data, that might help him get climb down from his perch a little bit.
I think, I think another thing that it's important to realize here too is that Jerome Powell, not being an economist, I think handled himself pretty well for a non-economist, talking about a lot of economic, economic environment and also his outlook. So I would like to see more of that today, but I agree that it's more likely to really focus on Frank, how we're going to reform. Jay Powell said something very important in that regard on Tuesday, and that's that he sees the merger of both regulatory powers and monetary policy as being important for the Fed.
Ira, given that Powell spoke his own view, many have then asked the obvious follow-on to that. Does the rest of the FOMC fall into line? Do we have a problem here, or can the rest of the FOMC state their views, but as Mike said, Powell's is the one that matters?
Yeah, well, I think that it's always been, at least since Ben Bernanke took over, it's been, trying to create a consensus, but at the same time, everyone having slightly different views. Jerome Powell didn't really talk about that. His communication policy seemed to continue to extend what both Ben Bernanke and Janet Yellen had done during their tenure.
Yeah. Kevin, just coming back to Tuesday, what do you think, or from what you've heard, how did that...
So now we're seeing a little bit of softness in the NASDAQ futures, as you can see here. Traveled right up to that 25 period moving average and has retreated from that level. A couple close and an open near the 9 period MA.
That other folks and other Fed chairs have had. For the large part, he has been a consistent successor to Fed chair.
Continue to extend both Ben Bernanke and Janet Yellen had done during their tenure.
Kevin, just coming back to Tuesday,
On the flip side of that, I think that he has been greeted warmly by Republicans in all factions of the Republican Party, including the more conservative faction of the Tea Party, which to some extent in the past, led of course by the likes of the Heritage Foundation, have questioned the transparency of the central bank. Largely, he has received warm welcome here on Capitol Hill. And to be honest, just anecdotally speaking, watching him walk in here today, he was very upbeat, smiling, chatty, and seems not to be carrying himself in a way that his successor did, at least on the way in the hearings.
He is delivering his statement again now. It's usually the same statement as Tuesday, maybe a few minor modifications. We'll jump in as soon as the Q&A session gets underway. But I want to ask Michael McKee what we know now about economic growth, since even Tuesday. We've had some new data, including this morning the PCE core, PCE deflator, which is what the Fed, counts on, and things like initial jobless claims, which really were either as anticipated or better in a lot of ways.
If we could take it, I brought along a chart of jobless claims, hashtag BTV 2050. It's amazing. The lowest jobless claims since 1969. I don't want to even guess how many years that was before you were born. It was a long time ago that we saw claims this way, and the labor market has grown a lot since then. So this is really remarkable. It shows you how tight the labor markets are. Raises that question about why we haven't seen wage increases move faster, but we'll see if that continues. Powell on Tuesday suggested we are going to see that going forward. The ISM numbers came in very strong today, suggesting that manufacturing is still going well. Big gains in export orders, which is something that should make the president happy and increase manufacturing because the dollar's been weaker. It's been getting stronger. Don't know if that'll continue.
There's a song about the summer of that year, I believe, so it has to have been a good year. Ira, let me ask you about how tariffs are going to impact all of this, if at all, because we're going to get an announcement today, and we kind of know that there are going to be tariffs imposed.
Yeah, so I think that really will that could affect obviously the global economy and some of the trade figures. So obviously, we've had a more open and kind of global environment since we had NAFTA, the WTO, the GATT agreement, and all of those things in the 90s. So a pullback of that it's a little bit unclear what type of economic impact that will have. The United States is overwhelmingly a service economy as opposed to necessarily goods. So it's a little bit unclear. Like at the margin, maybe it could help some industries, but it might hurt a lot of others because presumably there'll be some retaliation on this too.
Yes, Michael?
Back in the early 2000s, George W. Bush put tariffs on, and they say they saved maybe 10,000 jobs or so in steel, but they, according to studies, lost as much as 200,000 jobs in other industries that were related to steel. So there's a question of really how much impact this will have. There's 85,000 steel workers, but an estimated 1.6 million people working downstream steel and aluminum using industries. So there are knock-on effects. And as Ira said, price questions, very unclear here because, yes, steel prices will go up. Caterpillar tractors will get more expensive. Cars will get more expensive. Refrigerators, anything made with steel. But if China puts on tariffs on U.S. agricultural products, they'll get cheaper. We saw sorghum prices fall when China initiated an investigation into sorghum dumping after the president put on those solar panel tariffs. So we could see a sort of an offset there. Hard to say exactly how it affects inflation.
And Kevin Cerulli on Capitol Hill, let me ask you what's going to happen this week, because we have China's top emissary, in the area of trade and, those kinds of relations, Liu He, in Washington today, in fact, even as President Trump is going to announce these tariffs.
Yeah, so on the first point I'd raise is that domestically speaking, this would help President Trump in states like Ohio and Pennsylvania. But internationally, it gets more interesting. Canada, the top trade importer to the United States with regards to steel. And of course, NAFTA talks nearing completion. You've got the TPP round in Chile about March 13th. China doesn't like this. The European Union doesn't like this. The beverage industry domestically doesn't like this. And neither does South Korea, which has already said, the second point I'd raise, that they would ship business to Southeast Asia or even to Russia. But in terms of where this goes, you've got the tariff announcement today, and I can tell you that we've got this interview that I just did with Senate Banking Committee Chairman Mike Crapo about regulatory relief and the timing of that. That could happen early next week. Take a listen to what he told me.
I don't know exactly because it depends on how the leader is able to manage the nominations that are now ahead of us. But I expect that sometime either Monday or Tuesday we will move to the first vote, which will probably be a cloture vote.
We should note that the Senate version of the Dodd-Frank regulatory relief package is very different and more moderate than what the House had passed several months ago. But if you're in the banking community, this is a giant step forward in terms of the legislative process. Should it get floor time, reg relief coming for community banks as early as next week.
Michael, on Tuesday I asked you what question
basically these guys are just going to talk over it. Jay Powell's reading his opening statement, which is the same opening statement that he read on Tuesday. So nothing really noteworthy there. Once we start moving to question and answer, there will be a little bit more to pay attention to. as we look at the S&P and looking at stochastics again, everything's lining up for a bearish March. If you watch the video edition of Trader's Espresso this morning, I talk about this and compare it to history. Generally speaking, you don't see a bearish stochastic crossover on the monthly chart like that without having it followed by some kind of even if it's a mild downturn. Maybe it's only 1 month, but more often than not, it's multiple months.
For the Senate to confirm Vice Chairman Quarles as soon as possible.
Well, thank you for raising this, Senator, Mr. Chairman. I absolutely agree. It's very important that Vice Chair Quarles get his full term. So at this point, he's working on an expired underlying governor term, but he has a 4-year chair term, and I think to have him fully installed is very important that he have this underlying governor term.
All right, thank you. I appreciate your emphasis on that, and hopefully that will help to encourage the Senate, the full Senate, to move more expeditiously on that nomination. Senator Brown.
Thank you. I appreciate my friend and colleague, Chairman Krapos, skillful, narrow and leading questions about his legislation. I think it's important to point out that the question particularly about foreign banks, the Deutsche Bank and Santander, and those banks that have been both troubled and troubling, will be mostly deregulated under this bill because they're under 250. That's not really my question. I want to get to questions, but I also want to point out, in spite of this chair of the Federal Reserve general satisfaction with this bill, that there have been serious questions raised against it, raised about it by former Fed Chair Volcker, by former Fed Governor and Deputy Treasury Secretary Sarah Bloom Raskin, by Bush appointee former FDIC Chair Sheila Bair, by former Consular and Treasury Secretary Antonio Weiss, and by the former Deputy Governor of the Bank of England Paul Tucker. I think it's important to note that it's not all candy and roses here. Let me talk about a couple other things. Unemployment rate's been steady, 4%, 4.1%. Wage growth, as you know, Ms. Chair, has been slow to improve. At your confirmation hearing in November, you mentioned that labor force participation for prime age workers was also lagging. I'd like to see improvement across the board, as I know you would. Two questions related to that. Do you think it's possible to achieve further improvement in wages and employment among workers that have been left behind without causing higher inflation? And will you commit to looking at all the data and considering the workers who have struggled the most so as to avoid raising rates preemptively and cutting off the chances for broader economic gains?
Thanks, Senator. So participation by prime age workers is a full percentage point below where it was before the crisis.
Now in the cash markets, the Dow has crossed above zero. It's up 35 points, as has the S&P. The NASDAQ is 100 is considerably weaker than it was earlier. Or I should say it's weaker compared to its sister indices, with the exception of the Russell.
Can take place without causing inflation. We'll, of course, be monitoring that, and I think the risks are much more two-sided than they were 2 or 3 years ago when there was a great deal of slack in the labor market.
And I appreciate, as I told you in person, your interest and commitment to both mandates of inflation and employment. One Fed nominee that's still in abeyance may not, or may have the votes, may not have the votes on the floor, doesn't take that position. Your position there is crucial, as Chair Yellen understood, as Chairman Bernanke understood. Second question, Morgan Stanley and other Wall Street analysts have said that only 13% of the reduced taxes under the tax bill being paid by companies will go to workers' pay. 18% will go to mergers. If that ratio holds up for banks, 18% will go to mergers, 13% for worker pay. If that ratio holds up for banks, whether it's the tax bill or the chairman's bill he talked about, shouldn't we expect even more bank consolidation?
First, I'd say we don't really know yet how that will shake out, but taking your hypothetical, would it add to more consolidation among the banks? Bank consolidation has been going on for 30-plus years. It's got a lot to do with smaller banks and economic activity moving out of the rural areas into the city and interstate banking and things like that. I'm not sure this would tend to change the trend.
Yeah, I appreciate what you just said, because I certainly heard the deregulators in this body. There was this stuff with this collective amnesia about what happened a decade ago. Always blaming bank consolidation on Dodd-Frank, when, as you point out, it's been going on for years. Mr. Chairman, I'd like to. Here's an American Banker article from November that discusses your bill. The title is "SIFI Hike Could Kickstart Bank M&A," and I asked to enter that in the record. Without objection. Thank you. Last question today. Most of the Wall Street, the big Wall Street bank offenders most of the Wall Street banks have been repeat offenders since the crisis. The Fed and other regulators have fined them. You were part of this. $243 billion in combined penalties, money laundering, market manipulation, deceiving customers, you name it. The chairman's bank deregulation bill would mandate that the Fed further tailor rules for the largest banks. Meanwhile, Vice Chair Quarles is talking about the Fed's plans to make living wills less frequent, to reduce leverage rules, to weaken the Volcker rule. Why should big banks that have consistently failed to follow the rules benefit from statutory or regulatory rollbacks?
I would just say that our focus is very much on the smaller, medium-sized banks. We want the post-crisis regulatory initiatives like higher capital, higher liquidity, stress testing, resolution. We want those to apply in their strongest form to the largest institutions. We want to make sure we're doing that efficiently, and there are some changes we can make in that regard. But most of what we're doing really applies to banks.
I sat with Senator Crapo and a number of others that are in this room on the Finance Committee, and I heard Republican after Republicans say the tax cut was all about the middle class, yet 81% of the benefits went to the wealthiest 1%. I hear you, and I hear the push for this S2 155 being all about the community banks. But we know much of it's driven by what happens for the larger banks, the weaker stress tests, the periodic stress tests, what we're doing instead of annual, what we're doing for the foreign banks. So I hear your talk about your interest primarily is the smaller banks, but I guess the question still stands: why should anything in this bill? Why should we do anything for the largest banks, as this bill does? Why should we do anything for banks that have consistently failed to follow the rules? Why should they benefit from statutory and regulatory rules rollback?
You know, as I see the parts of the bill that I'm familiar with, they really apply to banks 250 and under. And when I think of when you say largest banks, I think you're talking about either the 8 SIFIs, by the way, one of which is below 250 billion in assets. So we're very capable of reaching below 250 to apply.
Excuse me.
When it's appropriate. But it's really those institutions that I would call the large and complex institutions, and the focus there again is on sustaining the 4 pillars that I mentioned of post-crisis regulation, and maybe looking at making them more efficient. They don't need to be more. They shouldn't be more burdensome than they need to be. But I really strengthen and hold on to those.
Well, I hope in your conversations with the chair of supervision, Mr. Quarles, that you will insist that this is about the banks under 250, and insist on that it's not about the banks over 250, as some on this podium have suggested. Thank you.
Thank you, Senator Shelby. And I do remind our colleagues that we need to stick to the 5-minute rule.
That's prospective, isn't it, Mr. Chairman? Chairman Powell, you referred to price stability just a few minutes ago. It's one of the mandates for the Fed and your job. Let's talk a little about price stability and unemployment being real low. Prices, you
Russell's crossed into positive territory. Other cash indices seem to be firming. The Dow is up almost 100 points. The Nasdaq 100 is up 16. The composite's up 14, and the SPX is up just shy of 10. Volatility has come in considerably.
In the future, is that because of your concern?
S&P volatility is still positive, and volatility on the Russell is actually now negative.
So to speak, mostly pressure on wages, or where's it coming from? In other words, or is it all of it?
Senator, so where we are now is we've got unemployment, as you know, at 4.1%, which is sort of at or near or even below most estimates of the natural rate of unemployment. But we have inflation that's still a little bit below. So by continuing to gradually raise interest rates over time, we're trying to balance those two things and achieve inflation moving up to target, but also make sure that the economy doesn't overheat. Now, there's not a lot of evidence. There's no evidence that the economy is currently overheating, but that's really the path that we've been on, and my expectation is that will continue to be.
That statement will cause markets to go higher,
as long as the economy performs this
and
way.
it is, as a matter of fact.
It's a substantive path too. I agree with you.
There's no evidence that the economy is overheating.
Going to be a push for higher wages. You see a little of it now. The economy's good. People seem to be doing well. The tax cuts come in, which is probably going to help. We see that it's going to help at least confidence and everything in the economy. What do you see there?
It's interesting. Unemployment has declined from 10% at the worst part of the crisis, and actually well after the crisis, down to 4.1% now. And wages have only really gradually started to track up. The increases are now up at about 2.5% if you blend the various measures we look at. We look at a bunch of them. And I will be honest, I would have thought that you'd see more wage increases by this point. And I do expect that we will see more wage increases. We've got an economy with strong momentum. We've got strong job creation as a result of it. We've got low unemployment. And I do think you will begin to see wages coming up. We've been feeling that way, and that's kind of what we're waiting to see. Hope we see it soon. Expect to see it.
How important to the economy and to the monetary policy is price.
It's off to the races now. I mean, that's all the markets needed to hear was Jerome Powell saying that there's no evidence that the economy is overheating.
Absolutely, the very heart of what we do.
I'd like to switch over to your other job, and that is dealing with regulatory issues. Cost benefit analysis unit. It's my understanding that the Fed has announced recently its intention to create what they call a policy effectiveness and assessment unit to conduct cost benefit analysis on regulations. If that's so, I applaud that effort. A lot of us on this committee have pushed that for years, believing that there should be an analysis, a real cost benefit analysis to every regulation. What's the status of this group's development, Mr. Chairman, and what do you hope that will come out of this?
Yeah, as you know, Senator, we always try to implement regs in the regulations in the way that's least burdensome and also faithful to the intent of Congress. In this particular case, we're trying to raise our game here by having a specific group of quantitatively oriented people who are focusing just on that. We have lately published cost benefit analysis on specific regulations like the SIFI surcharge, long-term debt, and things like that. So, we're trying to raise our game here. By the way, whenever we go out for comment on a reg, we also ask for the public's views on costs and benefits. So it's really important to us. And as I said, as you pointed out, we're trying to raise our game.
A lot of it, though, is letting the public know what all of this is about and what the cost will be, and to them as well as to the economy, is it not?
It is, and that is our obligation, is to be transparent about those things.
Thank you. Thank you, Mr. Chairman.
Thank you, Senator Tester.
Yeah, thank you, Mr. Chairman and Ranking Member Brown. I appreciate you having this hearing, and welcome, Governor Powell. It's great to have you here. There has been a perception being floated by some that the largest foreign banking organizations, such as Barclays, UBS, Deutsche Bank's been talked about today already, will be released from enhanced prudential standards under the economic package brought forward called S2155. I fundamentally disagree with that. I think it's those views are a myth and certainly not the text that is in S2155. But I'm a dirt farmer, okay? I just kind of read things as they are and don't read a lot of extra stuff into it. You're the man on the Fed, and so I need to know your opinion. Does 2155 require the Federal Reserve to weaken any of the Dodd-Frank enhanced prudential standards for the FBOs such as Deutsche Bank, UBS, or Barclays?
It does not, according to my reading of the text.
Can you elaborate briefly, if possible, on how those standards are applied to the largest FBOs?
Well, currently, what the bill does is it moves up to 250 for these institutions, but it looks at their global consolidated capital. So, now we have intermediate holding company requirements for these companies, and none of those will be affected by this. And what that means is that they're required to keep capital and liquidity here in the United States it's commensurate with their activities. They're also subject to living wills and things like that. So, it's a range of enhanced prudential standards. The intermediate holding company thing is an extra one that we gave them.
Okay. Thank you. I'm also frustrated that some have jumped to conclusions about how or what might happen regarding international holding company requirements. So just to clarify, from your perspective, the creation of the IHS was not included in Dodd-Frank, correct?
That's right. That was something that we added on independent of Dodd-Frank.
And the legislative language in S2155, the bill that we've been talking about this morning a lot, does not require any change to the IHC, correct?
It does not.
Okay, thank you for clearing that up. Now, I asked you this question during your confirmation, right around the time that 2155 was released. It's been nearly 3 months, and that bill has made its way through this committee and has overwhelming bipartisan support. And hopefully we'll see the floor next week. And what I asked you at that juncture was, do you believe 2155 puts our financial system at risk? At that moment in time, you said no. So now you've had a little more time, get your feet on the ground. Do you continue to believe that?
I do.
Okay, lastly, go ahead.
I can elaborate if you want.
Sure, have at it.
Okay. probably the most significant piece of it is that you raised the threshold for enhanced prudential standards to 250, but you give us the ability to look below 250. We will publish a framework that addresses, we'll put it out for comment, that addresses how we'll think about that. We have not been shy about reaching below 250. One of the 8 SIFIs, in fact, is below 250 billion in assets. So I think it gives us the tools that we need to continue to protect financial stability.
Thank you. Lastly, I think it's important for folks to remember that the Federal Reserve and Chairman Powell have a number of tools in their toolbox when it comes to regulating our financial institutions, well beyond that, what we even created in Dodd-Frank. I think it's important to remember that things like advanced approaches, CCAR, Basel, were created by Dodd-Frank. And if I'm not mistaken, advanced approaches and CCAR were put in place during Republican administration. So I guess my question for you, Chairman Powell, is this. Can you remind folks what your Safety and Soundness Authority means to the Federal Reserve and what that authority it gives to you?
It gives us broad authority to, except in places where Congress has addressed particular areas. We have broad safety and soundness authority to do capital requirements and of various kinds, liquidity requirements and things like that, and look after the safety and soundness of all depository institutions.
Thank you. I just want to close with saying that I don't for a second think that Dodd-Frank was the only reason we're seeing consolidation in banking. I think technology plays a big role in that, and population shifting plays a big role in it. On this committee, I can deal with Dodd-Frank. Thank you, Mr. Chairman.
Thank you, Senator Corker.
Thank you. Welcome, Mr. Chairman. It's good to have you here, and congratulations on your confirmation. You talked about the accommodative fiscal policy that's in place right now, and just out of curiosity, I know there's people predict y'all are going to raise rates 4 times this year. You're definitely going to raise rates some. How much did the tax bill that was put in place, how much of that is affecting your desire to or your likelihood of raising rates over this year?
Tax bill.
I wouldn't single it out, Senator. I would say
I'm not trying to single it out, but just out of curiosity, it is in fact something that is going to be stimulative. So, how much of a factor is it in looking at raising rates?
Fiscal policy is one of many factors. We're looking, as you know, we're looking at stable prices, maximum employment. That's what we're looking at, and everything that happens in the economy and financial conditions and fiscal policy affects that. We can't really isolate one thing, like fiscal policy, but I think, I would expect that fiscal policy this year is going to add meaningfully to demand, and that's going to put upward pressure on inflation and downward pressure on unemployment. It's hard to quantify, but it wouldn't be the main factor. I mean, the economy's strong, and it's even stronger now.
Yeah. So then, as it relates to growth, you said it was going to increase demand. How much of a factor is it in your growth projections, the passage of the tax legislation?
As I mentioned, I think it will add meaningfully to growth for at least the next couple of years. The real question is, how much will it add to? And the amount of that is subject to very different estimates by different approaches. But I guess the bigger question is how much will it add to longer run growth? And there are a couple channels through which that might happen. Higher investment should lead to higher productivity, which would raise potential growth. Lower tax rates on individuals should increase labor supply. These are highly uncertain, but we hope the effects are meaningful there as well.
Mm-hmm. We've been through a decade now, I guess, since the crisis, and many of us were here during that time. It was a pretty heady time trying to resolve those issues, and yet we went through periods of time when we were worried about deflation. Obviously, we had really accommodative monetary policy during that time, and here we are again at 4.1% employment, down from 10, as you mentioned. The economy's strong, and yet still, let's face it, 2% inflation. I know y'all are combating anything getting out of control. Elaborate on the factors that in this day and age, in this economy, in this world situation, what is it that is keeping inflation at such a low rate?
It's a global phenomenon, and we don't perfectly understand it, but I would say since the crisis, a big factor that's been weighing down on inflation has been just the weakness in the economy. You've had a lot of slack, and the economy has not been tight, and so that it makes sense that that would press downward on inflation. We also had, the strong dollar and lower oil prices in 14 and 15 that pushed down, and so. More lately, we would have expected inflation to come up by a few more tenths than it has, and we see identifiable idiosyncratic factors. There are other stories, though. There's the Amazon effect story. There's global slack. The idea that slack around the world is affecting the tightness of the U.S. labor market. Really hard to tie those down from an empirical standpoint, but they may be having some sort of an effect on inflation as well. It is a global phenomenon, though, so it's not just tied to domestic factors.
So I know that my friends on the other side tend to focus a lot on the tax bill, and there's hope that growth is going to overcome any kind of deficits there. It may or may not occur, but we are, in fact, getting ready to spend $2 trillion more that we don't have by passing the bill we just passed. We've got our omnibus coming up over the next 10 years. It's a minimum of $2 trillion in additional spending, almost twice what the president requested, and we have $21 trillion in debt today. How much does the deficit picture for our country come into play relative to the Federal Reserve, and how concerning is it to you that we continue just to party like there's no time ending here in Congress?
We're not on a sustainable fiscal path. We need to get on one. This is a good time to be doing that when the economy is strong, that's a longer run problem. It isn't really. It's not a problem for today's monetary policy or economy. It becomes a problem gradually over time as we spend more and more of our expenditures on interest rate, on debt service, and we have less and less to do the things that we really need to do, and as we pass along bills to future generations. But the unsustainability of our fiscal path isn't something that has too much of an effect in the near term on our policies.
Thank you, Mr. Chairman. Thank you.
Senator Menendez.
Thank you, Mr. Chairman. Welcome, Chairman Powell. Good to see you. I want to follow up on some questions that my colleague, Senator Brown Helby, asked you about. Inflation is continuing to run below the Fed's 2% target, which has prompted a majority of regional Federal Reserve Bank presidents to urge a study of the current inflation framework. And while we have seen significant economic gains since the worst days of the recession, most hardworking families are still waiting to see their paychecks rise. Real median wages increased by only 14% from 1979 to 2017, and any recent acceleration in wages is accruing to high-paid executives and managers, with production and non-supervisory workers simply not seeing those gains. The Fed's projecting a minimum of 3 interest rate increases in 2018, and after your testimony on Tuesday, the markets are now anticipating as many as 4 hikes. Do you agree that the achievement of full employment should be associated with strong and broad-based wage growth for average workers, not just increases for executives and managerial pay?
I do, Senator.
And if so, doesn't that argue for consideration of a monetary policy path that would allow wages to continue to grow prior to the Fed's pumping the brakes?
I agree that it does, and I believe that is in fact the path we're on. These are gradual rate increases, and we do expect wages to move up.
What would the cost to the economy of overshooting inflation in the 2 to 3% range versus the cost to the economy of choking off growth if the Fed continues to tighten without a clear indication that inflation is going to exceed its target be?
The risk, one of the risks we're trying to avoid, I think, as I mentioned earlier, the risks are more balanced than they used to be. For many years, it was clear there was a lot of slack in the economy, and I, for one, supported accommodative policy. At this point, we have 4.1% unemployment, and the thing we don't want to avoid in that we don't want to have happen is to get behind the curve, have inflation move up, and have to raise rates too quickly, cause a recession. And recessions, they hit the most vulnerable groups the hardest. And so that's where unemployment goes up the fastest and that kind of thing. So to prolong the recovery, the committee's view is that we should continue on this gradual path of rate increases, which balances lower inflation and low wages against the need to make sure that we don't run too far past the natural rate of unemployment.
Mm-hmm. Well, I hope you'll continue to look at wage growth as part of your calibrations. Let me ask you this. During the confirmation hearing, I was pleased to vote for you. I asked you about the economic risks of adding an additional $1.5 trillion to the deficit. And I just heard your responses to my colleague from Tennessee that we're not on a sustainable path. We need to get one. Obviously, we weren't on a sustainable path before we added $1.5 trillion to the debt in the tax cuts that were generated. And you then said in response, and I quote, "I think we need to be concerned with fiscal sustainability over the long term." And in the same hearing, you agreed with Senator Van Hollen when he asked you said adding $1.5 trillion to the deficit would make a bad situation worse. Now, your predecessor previously testified before this committee when she said, quote, "I'm personally concerned about the U.S. debt situation. Taking what is already a significant problem and making it worse is a concern to me." Do you agree with former Chairman Yellen that there is reason to be concerned about mounting deficits and growing national debt?
I do, and I'll follow what my predecessors have done and not get too much into the details of fiscal policy, but I will say a couple of things. One is, as I mentioned, we need to get on a sustainable fiscal path in the longer run. We know that we're not in the longer run. Second thing is when we do fiscal policy, when you do fiscal policy, I think it's important to keep in mind measures that would increase the productive capacity of the United States, of the economy, things that would increase productivity, that foster investment in people, in education and training, in R&D, and in plant equipment as well. But those kinds of policies can help the whole economy grow faster on a sustainable basis.
I agree with you. It's just that stock buybacks don't quite do that. Let me ask you the last question. In January, the New York Federal Reserve Bank president said that tax legislation is likely to generate frictional costs that will mitigate its effects on growth, namely disparate impacts regionally. In particular, President Dudley was pointing out the gutting of the state and local income and property tax deduction, which would raise the cost of ownership and adversely affect prices and construction activity in states like New Jersey. Do you agree with President Dudley's analysis that states like New Jersey will see regional economic disparities as a result of the tax bill?
Senator, I hope you'll allow me to say that I'd rather not get into the particular details of any particular fiscal bill as chairman, and I think I'm happy to talk about things at a high level, but getting into commenting on particular sections in a fiscal bill, which is not our responsibility for me, is probably not a good idea.
Your president of the New York Reserve made that observation, so I would hope that we would look at the consequences to regional growth as part of your overall growth path. The region that I'm from generates nearly 20 to 25% of GDP for the entire nation. If we're going to have policies that ultimately affect the ability to be that engine for part of economic growth of the country, we should be considering that as well. Thank you, Mr. Chairman.
Senator Cotton.
Thank you, Mr. Chairman, and Mr. Powell, welcome as your first appearance as chairman. First of many. I'm sure you have them all circled in your calendar. Look forward to the eagerness as a child does to Christmas, right?
Indeed.
I want to talk about the labor market, in particular wage growth for America's workers. An article in the Harvard Business Review last October discussed wage trends since the 1970s and found that wage gains have mostly accrued to top earners, while wages have declined or been stagnant for the bottom half of the income distribution. The bottom half of the income distribution is comprised of many Americans who don't have a four-year degree, many who don't even have a high school diploma. Research from the Economic Policy Institute shows that American workers without a high school education have seen their wages decline by 17% since 1979, adjusted for inflation. And for workers with a high school education but no college, wages have declined by 2%. The chart to my left displays this, shows what I'm talking about. You can see the massive wage growth for those with a college degree or an advanced degree, and wage declines in real terms for those with a high school degree or less. One of my top priorities is to ensure that hardworking Arkansans can share in the economic prosperity that we see in our country in ways that they have not over the course of my lifetime. Mr. Chairman, you write, I should say the entire board writes on page 2 and 3 of the Monetary Policy Report, although there is no way to know with precision, the labor market appears to be near or a little beyond full employment at present. What's your personal assessment of this matter? Is the economy at full employment today?
You know, as we say in our statement of longer run goals and policy strategy, we look at a number of, there's no place you can directly observe it, so we look at a range of indicators. And I would say most of those indicators say that we're either at or beyond full employment. There are a couple that suggest maybe we're not. I would point to wages, and I'd point to labor force participation by prime age males. This is a long answer. It's hard to give a really clear answer, but we don't actually know precisely where full employment is. Put it all in the blender, it seems to me we're very close to full employment.
Yeah.
To pick up on your regions, I would add, that isn't the case in every region. Or yeah.
To pick up on your point about labor force participation, while our unemployment rate is a bit of good news.
NASDAQ and NASDAQ Composite have now turned negative. Russell's barely negative. S&P barely turned negative. The Dow has come in considerably. It's flat. So I'm not sure if this is a reaction to, markets not liking what they're hearing. Jerome Powell say a line of questioning. There seems to be vacillating back and forth. Mr. Powell made a statement that there's no evidence that the economy is overheating. On the other hand, just now we heard him say that the economy is either at or near full employment. Now, the question is going to be, okay, does that mean that inflation will gain traction? Because the core PCE number came in today at 1.5, and the Fed's target is 2. So they're still not hitting their target. They're seeing wage inflation, but they're not seeing inflation overall.
Labor force participation has been essentially flat since the back half of 2013, so a little more than 4 years, and the downward trend might be 25 basis points a year. So I look at us as having made up probably the slack that emerged, fully made up the slack that emerged as part of the crisis.
And the wage growth we've seen over the last year, while good, I would suggest it's still not good enough, especially as long as we have those missing workers. So I'd hate to say, putting aside all the other reasons why you might see rate increases in the coming months ahead, rate increases because of continued increases in wages, especially for working class Americans. And the labor market, like any other market, is a market that's driven by supply and demand, correct?
Yes.
So if the supply of labor exceeds the demand of labor, then you'd see downward pressure on wages. That's one reason why I and some other senators, like Senator Perdue, have been focused on our immigration system. If you could magically convert 1 million high school graduates in this country to 1 million Stanford graduates that could go to work in our high-tech industry, then presumably that would be good for the wages of working class Americans. Well, that's essentially what we do every single year, is that in reverse, is we bring in 1 million unskilled and low-skilled workers that are competing against the very people who have not shared in prosperity, and for that matter, competing against the previous generation of immigrants. I don't think that's good for American citizens. I don't think that's good for our economy. And we'll continue to work hard to make sure that those workers can share in the prosperity that all Americans in the upper income brackets and college educated and more have shared in the past. Thank you.
Senator Schatz.
Thank you. Chairman, thank you for being here. Thank you for being willing to serve. I want to talk about student loan debt. There is currently $1.4 trillion in outstanding student loan debt, the highest category of consumer debt behind mortgages. It's also the most delinquent, with 11% of borrowers seriously delinquent or in default. The Fed estimates that this number is likely closer to 22% once you take into account the number of borrowers who are in forbearance. In contrast, at the height of the financial crisis, mortgage delinquency was just under 5%, and currently that rate is around 1%. According to the Federal Reserve's data, high levels of student debt have contributed to lower rates of homeownership and new business starts. And so, in your view, does the high level of student debt create a drag on the economy?
On student loan debt, I think it's important that people be able to borrow to make what may be the most important investment of their lives, which is in their education. So overall, I think borrowing to invest in yourself is something we should foster, subject to a couple of important caveats. First, it's very important that people understand the nature of the borrowing and the risks that they're taking and the possible payoffs and that sort of thing, so that they make informed decisions. The second thing is, I think a loan among all kinds of debt, we don't allow student loan debt to be discharged in bankruptcy.
Right.
I'd be at a loss to explain why that should be the case. So it's something, and this is fiscal policy, this is something for you, not something for the Fed, but we do see, as in Fed research shows and other research shows, you do start to see longer-term negative effects on people who can't pay off their student loans. It hurts their credit rating, and it impacts the entire path of their economic life.
So that's the public policy argument for us to do something about student loan debt and the way we structure higher education financing. My question for you is, do you see this as a macroeconomic risk?
It will over time. It's not something you can pick up in the data right now, but as this goes on and as student loan continues to grow and becomes larger and larger, then it absolutely could hold back growth.
Okay, thank you. And I want to thank you for your willingness to have an open mind on the question of the economic impacts of climate change. I appreciated your answers in the questions for the record. And so I'm glad you're willing to talk about it. But your position is that the Fed is only concerned with, and I'll quote, short and medium-term developments that may change materially over quarters and a relatively small number of years rather than the decades associated with the pace of climate change. Now, there are experts within the government that would strongly disagree that the problem of climate change is measured in decades. They would say we are seeing the economic impacts now. NOAA reported 16 separate billion-dollar climate events in 2017. Combined, these events cost the United States economy $300 billion, 1.5% of GDP. 2017 was a record-breaking year, but according to NOAA's science, it will get worse. The number and cost of these events has more than doubled over the last decade, and it has increased eightfold in the last 30 years. So I understand that your aperture is short and medium term. That is sort of a premise of how you operate. What I'm not accepting as a premise of how you operate is the assumption that climate change belongs in the long-term category, because I think you are analysts. You believe in data. And what I'd like for you to do is challenge that assumption that climate only belongs in the long-term category, because the federal government scientists are starting to indicate that that's not the case. So the question is, are you willing to relook at that basic assumption that climate is just outside of your window, to sit down with our office and with federal government researchers to at least examine the question of whether or not, as you do your planning, it continues to belong in this long-term category, which is outside of your aperture?
Senator, as we discussed in your office, I guess, last fall, climate change is something that is entrusted to other agencies. We have particular responsibilities, particular tools, interest rates, supervision, looking out for the financial system. It's just not clear that it's really in our ambit, as opposed to in the ambit of other parts of the government. So, but we're obviously always going to be willing to discuss it with you, but I don't know exactly how it would fit into what we do with our tools.
I guess the question, I mean, I understand what you're saying, but I'm trying to figure out why a 1.5% hit to GDP last year, and the agency that knows about such things is telling us to expect more and more of it, why that wouldn't be in your ambit. First time I've ever used that word.
Well, our ambit involves, moving interest rates up and down and supervising financial institutions. So I don't know. I'm not sure how it would enter into that.
Okay, I look forward to continuing the discussion. Thank you.
As do I. Thanks.
Senator Perdue. Thank you, Mr. Chairman. I'm Googling ambit over here in the meantime. Sorry. Chairman, thank you for being here again. I have a question. You mentioned in your opening comments about that foreign demand for U.S. exports is up, and I happen to believe if we're going to be north of 3% GDP growth, we've got to grow our exports, and I think you've made those comments publicly as well. But the low interest rate environment of the last decade has shown a proliferation of new lending, really a binge of new debt issuance in the third world, developing world, let's say that. And just this year alone, a lot of that short term. So this year alone, there's almost $2 trillion of that developing world debt coming due this year. And about 15% of that's denominated in U.S. dollars. Do you see that as we normalize rates here in the U.S., with the U.S. dynamics that we're talking about between inflation and unemployment, that the impact that could have on the developing world could, in effect, have some systemic risk on not only the global economy, but on our own recovery?
Senator, what we can do is we can be transparent, we can be predictable, and the markets can therefore understand what we're doing and be ready for it. And I think if we do that, we use our tools to achieve stable prices and maximum employment here in the United States and financial stability. And so what we try to do for the world financial markets is be really clear about what we're doing, predictable, transparent. As I look at the state of the emerging market countries and their financial markets and financial regulation, they're a much better place than they were 10, 15 years ago, even 5 years ago. There's not as much dollar-denominated debt, foreign currency-denominated debt. They have better institutions. Not everywhere, but it's a much better picture than it was 20 years ago, let's say.
So following up on that, you talked earlier about reducing the size of your balance sheet, and that's been an ongoing effort even before you took office, as I understand it. So the question is, the four big central banks, China, Japan, U.S., and the EU, all have similar-sized balance sheets, somewhere between $4 and $5 trillion. As you normalize or as you begin to consider taking our balance sheet down to a more normal level, what actions do you monitor of these other central banks, or is it totally independent when you make those decisions?
Well, we monitor all financial conditions and economic conditions in our in what we do. The normalization plan that we adopted through the summer and then put into place in the fall has been accepted very well by the markets. There's no obvious reaction at all. It's a gradual decline. We've said we're not interested in deviating from that unless unusual circumstances arise. And I think that should be the path. And I think we get to a more normal balance sheet size within about 4 years, give or take a year, let's say. The other large central banks that are talking about normalizing their balance sheets, they're behind that schedule. Our economy recovered sooner. We're raising rates sooner. So, there's going to be it's not going to be a synchronized thing. It's going to be something that's happening more seriatim. So, but we'll be watching that very carefully. We're very mindful of the issue that you raised.
Good. Thank you. One last question is a technical question. It has to do with the leverage capital ratio. It requires banks to hold capital against all assets, regardless of the risk of those individual assets. In operation, it's created kind of a risk-blind rule, and I understand the overall rationale behind creating this risk-blind rule. But the question I have is ultimately, I have a hard time understanding why assets like Treasury securities and funds on deposit at the Federal Reserve are also in that calculation. Can you defend that and answer the question if you're reviewing that practice?
Sure. So my view is that the binding capital requirement should be the risk-based capital requirement, and that would take into account treasuries and reserves and how risky they are. The issue is that over time, banks have figured out ways to gain risk-based capital. So we want a hard backstop, and that hard backstop should be high and hard. It should be the leverage ratio. We don't want the leverage ratio to be the binding constraint most of the time, because that, frankly, encourages people to take more risk. If you're bound by the leverage ratio, it's really saying you could probably use some riskier assets. So we like leverage, particularly risk-based capital has been vastly improved since the crisis. So that's how we think about it.
So how would you view right now in the few seconds we got left, just very quickly, what's your view of the general health of the entire banking industry in the United States, the capital formation arm of our economic effort in a free enterprise system? What is your assessment of the health of that industry today?
I think our banking system is quite healthy. I think we have high capital, high liquidity. We have banks that are much more aware of and capable of managing the risks that they face. They're much more ready to face failure if they do, because they have living wills. And I think we're seeing profitability. We're seeing returns on capital. And I think it's a good time in our system.
Right. Thank you, sir. Thank you, Mr. Chairman.
Senator Cortez Masto.
Thank you. Thank you, Ranking Member and Chair for this committee. And welcome Chairman Powell, it's good to see you again. So I want to follow up on conversation that you had with one of my colleagues, Senator Shelby, on the policy effectiveness and asset unit that you have created. Can you speak to how many people will work in the unit and how the importance of data will inform the decisions you make?
You know, I think it's 5 or 6 people now. I don't know how big it'll be, but it's going to be something in that range, maybe a little bigger. But the idea is that we'll have, you know, a strong quantitative approach that's tightly focused on cost-benefit analysis. I would stress we already do cost-benefit analysis in everything we do, but we hear outside that there's interest in doing more of that, and we're actively pursuing it.
And the reason why you're doing this is so that it can inform your enforcement and policy decisions, correct?
Well, yes, and the calibration of our regulations. We want to be able to implement regulations in the least burdensome way we can, consistent with safety and soundness.
And the data is key for your ability to do so, correct?
Very much so.
Yeah, and so I'm glad to hear you speak about the importance of data collection. I always support that, and it is critical to the work of the Federal Reserve. As I'm sure you're aware, the legislation that we've been talking about that's pending in the Senate, it would exempt 85% of depository institutions from full reporting of loan data under the Home Mortgage Disclosure Act. Can you speak to how this might impact the ability of the Federal Reserve to properly conduct its obligations under the Community Reinvestment Act, and whether the loss of this data might hinder CRA supervisory exams?
I'll be glad to. So as I understand it, the CFPB writes the HMDA rules and regulations, and we use that data in what we do in supervising the banks we supervise, which is a smaller group. In addition to that, sorry, I lost my train of thought. What Dodd-Frank did was that it took the base of historical data collection and it significantly increased that. So my understanding is that what's being looked at in the bill is to create a broader exemption from the Dodd-Frank additions. And so I think we traditionally get almost everything we need from the historical data, and I think we can continue to work on that basis.
Right. And that's my concern, is the more data, the better. I mean, you're creating a data unit because data is key to your decision making. My understanding is that the data that's used in the CRA supervisory exams seems to exclude relevant data points. Loans under $1 million are designated small business loans, even if they were not loans administered to small businesses. There's no analysis is made whatsoever of whether lending is occurring in communities of color, despite easy and accessible data via the Home Mortgage Disclosure Act. And so my question is, has the Fed considered broadening that criteria in its CRA supervisory exams? And what factors do you think would be helpful in determining whether small businesses, communities of color, and low-income areas are truly receiving the support that the law intended?
Are we still talking about HMDA data?
Correct.
So again, HMDA data is really an issue for the CFPB. They were given authority under Dodd-Frank to write the HMDA regulations, and we generally defer to them in terms of what their view is on that.
So you don't think that data is going to be informative in what you do with the Community Reinvestment Act and the oversight of that to ensure that that act is being enforced under the law to protect communities of color, to make sure there's no discrimination, to make sure that the loans are being sent to small businesses, and ensure that the money gets where it needs to go? That data is not going to be helpful for you?
I don't say that it wouldn't be helpful. What I would say is that, first of all, that's an issue that the CFPB actually has the lead authority on. In addition, we will still have, my understanding is that we'll still have under this bill the information that we've traditionally relied upon for just about everything we do under HMDA. So we may not have the additional data from some institutions, but we think we'll be able to function.
Well, let me just tell you, and my time's running out, so I don't have enough time to answer ask the additional questions that I want to ask you. But let me just say this. As a former Attorney General in the state of Nevada, my concern was discrimination against certain communities of color in learning. And the reason why we increased that data criteria is to ensure there was no discrimination and ensure that the money was going to where it was supposed to be going under the Act and federal authorities. And so I don't understand why we're rolling back that data and those data criteria. If you said it yourself, to be better informed, you're creating a data a unit for analytical purposes to create and collect data. I mean, it informs us in everything we do. And so my concern is just that. How can we say we don't want the data when we know it informs every decision that we're making, particularly to ensure the money's going where it's going and there's no discrimination?
We've been talking about data. Let me take a step back and say that any kind of discrimination by race or gender or any other unfair basis in lending is completely unacceptable. And we are committed as an institution to finding it and using all of our tools to stop it.
Thank you. I know my time's run out. Thank you very much.
Senator Kennedy. Senator Kennedy.
Thank you, Mr. Chairman. Good morning, Mr. Chairman.
Morning.
Do stock buybacks contribute to economic growth?
Well, if I can trace that out, when you buy back your stock, the money goes to the shareholder. They lose their stock. They can take that money and they do with it what they will. They can spend it. They can reinvest it. It doesn't disappear. So there should be some effect. I've asked this question. It's essentially impossible to really track that on a micro basis, but I would think intuitively it would go back in the economy and either be spent or reinvested.
Well, if a company buys back its stock and the value of the stock goes up, then somebody has extra money, right?
That's right. There will be a wealth effect as well, as you point out.
And they could invest that money?
They could spend it, invest it, and you're right, there would be a wealth effect from higher stock prices too.
And the stock going up is better than the stock going down in terms of economic growth.
It is, although I'm a little hesitant. I would want to say that it's not our job, as you know, to stop people from losing money or making money in the stock market.
Right. Last 60 days, bond market's been going down a little bit. What's that telling you?
You didn't use the word route.
The longer-term interest
bond
rates
market's getting routed,
and there are probably many reasons behind that. And I would just offer a couple. In my thinking, it's the expectation of higher growth. It's probably the expectation of inflation moving up a little bit closer to
when a critical patient is far from the hospital must come.
A realization that that growth around the world is quite strong. So we've seen strong recovery in continental Europe and in Asia, and so we're not the only game in town now. There are other. If money goes to other kinds of safe assets, that will tend to mean higher rates here. But these are all generally positive signs. So,
could it be a sign of inflation?
It could be a sign of slightly higher inflation, and we see slightly higher inflation. Inflation's been below our target since I joined the Fed almost 6 years ago.
You talked about us being at or near full employment. We're not at or near the optimum labor participation rate, though, are we?
The truth is, we're not far from the longer run trend. We have models that papers published 8 or 10 years ago, and they pretty much tell you that the labor force participation rate will be right about here. That's not really the answer to your question. Labor force participation by prime age males, for example, has been declining for 60 years.
Mm-hmm.
And there may be some good reasons for that, but there are a significant number of reasons that are not good reasons for that. So we as a country,
for that.
So we may be on our longer run trend, but the trend is not a great trend. There are many prime age males and women out of the labor force whose lives would be better if they were in the labor force. And these are not. We don't have the tools to really address that. But it would be.
In 2008, the labor force participation rate was a tad over 66%. Today, it's a tad over 62%. That's not good for the economy, right?
It would be great to have labor force participation at a higher level, as most advanced economy countries do. Our labor force participation rate is now, not even at the median of comparably wealthy countries.
And why is that?
It really is this trend of prime age workers leaving the labor force. A lot of them, that burden has been borne, as Senator Cotton was pointing out, by people with high school educations and below, the lower, less skilled and lower wage jobs. And it's been going on a long, long time. It's as I said, a 60-year decline.
But why, in your opinion?
I think it probably has to do with the evolution of technology. It certainly has to do with the flattening out in U.S. educational attainment. U.S. educational attainment went up for many, many years and then started flattening out in the 70s. And right about that time, U.S. wages flatten out and labor force participation starts to get weak. So we kind of reached a point as a country where we couldn't increase educational attainment, and really many things started happening right about then. The stagnation of median incomes, for example.
If we could jack the rate up to pre-08 levels, that would be an enormous stimulus to the economy, would it not?
It would. And of course, there's an underlying trend too of the aging of the population. So older people, even though older people work more than they used to after the crisis, older people still work less than younger people. So as the population ages, that's why labor force participation goes down.
Thank you, Mr. Chairman.
25 basis points.
Thank you, Mr. Chairman.
Thank you, sir. Senator Warren.
Thank you, Mr. Chairman, and it's good to see you again, Chairman Powell. As you know, a few weeks ago, on Chair Yellen's last day in charge, the Fed issued a consent order against Wells Fargo, prohibiting the bank from growing any larger until it made certain improvements. Now, the Fed also effectively forced Wells to remove an additional 4 board members this year. I've pushed the Fed for real accountability on Wells Fargo and its board for repeatedly cheating its customers. And I was glad to see the Fed take action. But I want to understand how the Fed intends to enforce the consent order now that you're in charge. The Fed requires Wells to submit 2 plans for approval by early April, one on improving the effectiveness of the board and one on improving the board's risk management practices. This is not clear from the order. Will the Fed Board of Governors vote on whether to accept these plans?
So we have delegated that approval to, I believe, to the head of supervision, but of course that will take place. I assure you that will take place in serious consultation with the board.
Consultation, but the board is not going to vote on this?
That's not the plan.
Well, I don't understand this. The Fed has issued a major, unprecedented consent order against one of the biggest banks in the world, and the Fed board, the people who are actually appointed by the president and confirmed by the Senate, aren't going to vote on whether the order is actually being followed.
Well, of course, we did vote unanimously on that measure.
It's whether or not the order is actually being followed, because that's the big question here. In my view, staff is not good enough, Chairman Powell. Fed board members are supposed to make the big decisions, and Fed board members are supposed to be accountable for these decisions. Will you consider requiring a vote of the Fed board before these plans are approved?
Yes.
Good. Thank you. I appreciate it. The next step is that an independent third party must review Wells' implementation of these plans by the end of September. Will you commit to making that independent review public, redacting any confidential supervisory information that's necessary? I think the public deserves a chance to understand how Wells is working to fix the mistakes that it has committed.
I cannot make that commitment to you without discussing it with my colleagues and with staff who are implementing this thing. I will look into it. Yes.
Will you look into it? Will you urge your colleagues to consider making this public?
If it can be made public,
I'm fine about redacting confidential supervisory information. But my view here is that the American public, given all that Wells has done, the American public has a right to see it. And all of those Wells customers who were cheated have a right to see whether or not Wells is actually following through on its promises. You can see why some people might lack a little confidence in that.
Right. So I will look at that, and if there's a way to do it that's faithful to our obligations and our practices, then.
Thank you. Good. And then lastly, the consent order says that the growth restriction remains in effect until Wells Fargo, quote, adopts and implements the plans that were approved by the Fed. So I want to be really clear on this. To lift the growth restriction, the Fed needs to see that the plans have been fully implemented, right? It's not enough that Wells has taken some preliminary steps toward implementing the plans. Is that right?
No, I don't think that is right. I think the thought was that once we've approved the plans and they begin to implement them, we see them on track, the growth restriction could then be addressed. No guarantee there, but we would then be prepared to look at it.
You know, I'm actually, then tell me how much progress along that line is enough to remove the growth restriction?
Well, I think, again, we'll have to be happy with the plan itself. We'll have to be assured that the company has made these really significant measures and suffered a significant period of a growth cap. And, we will not lightly lift it, but I think that's our understanding of how we're going to do it.
You know, the growth restriction is your really big stick here. And I hope that you won't consider lifting it just because Wells makes some marginal progress. Wells should fix its problems before it is permitted to grow any bigger. The consent order sent a powerful message to big banks that there could be real consequences, including consequences for senior officials if they break the law. But that message will be lost if the Fed does not enforce the order strictly and show the public and the banking industry that they mean business. Thank you. Thank you, Mr. Chairman.
Senator Tillis.
Thank you, Mr. Chairman. Chairman Powell, welcome. Thank you. And congratulations on your confirmation. Can you just explain, because I was watching a lot of the hearing in my office before I came up here, and you talked about global slack a couple of times. Can you explain to me what that really means?
The thought is that it has become, over the last 30, 40 years during our adult lifetime, possible to make just about anything, just about anywhere. Technology has enabled that, and rising living standards and capabilities in emerging market countries has created that opportunity. And the thought is that that capacity outside the United States is, in a sense, a form of slack. So that if you're, for example, a worker bargaining for higher wages, you're held back by this overhang of knowing that you can lose your job and that kind of thing. The issue is that globalization, most measures of globalization sort of plateaued out about at the time of the crisis, and yet it doesn't. That story makes a lot of intuitive sense, but it doesn't actually link up very well with the path of wages over the past few years. So it's something we've looked at and it gets written about a lot.
Actually, I think that's a very important point, because there's a lot of latent productivity that could be globally deployed, that as we talk about wages and we want to do a good job of moving wages in the right direction, they reach a certain point to where where we could plateau again, because that capacity, that capability to deliver.
Sorry for not having been very talkative, but I'm just really fascinated by this questioning and Jay Powell's testimony. I think it's pretty interesting. Of course, I studied economics in college, and he's not an economist, he's a banker, but he has a very sound understanding of economics.
And capital investment. And he was saying, a healthy percentage of GDP is somewhere around 8%, and we were trending down in the 4% range. Do you view that as a key indicator that we have to increase? And what, if any, trends are you seeing that give you some sense that we're getting to?
Oh, right. I'm going to turn the sound off there. It's 9:30 Arizona time. It's 11:30 East Coast time. Time for traders to head out to lunch. I know the Senate Banking Committee will not be breaking for lunch. They'll be continuing this testimony until they're done. I will see you on the other side of lunch here back on the live stream, right around 1:30 Eastern time. Thanks for checking in, and I'll